Hello everybody. Today we continue our discussion of monetary policy, in particular about the European Central Bank. And I will show you the outline of the day. So I will start with the topic we finished last time, and that is the discussion about unconventional or non-standard monetary policy measures. And then we continue our discussion of the central bank response during the financial crisis. So what has happened for the central bank during that time, and so what is the response? Obviously these 2 points are closely connected. And then we move on to a topic we have not touched so far, but that is linked, you will see this, to monetary policy as well. And that is the Phillips curve, because in the last point of the day, I will illustrate a simple model about the central bank. And one element of this model is the Phillips curve. And in this model, I will demonstrate you the idea of medium term. So last time we talked about that the primary objective of the European Central Bank, Article 105, is price stability. And then we looked to the definition, how the central bank is defining price stability, and the key definition was, well, inflation below but close to 2% over the medium term. And my goal is to explain a little bit more what is behind this definition of medium term. And we will see in this model that inflation expectations, so the expected inflation rate, is a key element of the current inflation rate. So if the central bank intends to keep the current inflation below but close to 2%, the central bank has to anchor inflation expectations of you and me. And that is one of the messages of this model we will discuss at the end of the day. So let me start now with the first point, and that is the unconventional monetary policy measures implemented by the European Central Bank since the onset of the financial crisis 2007-2008. So last time we learned a lot about these open market operations. I showed you a table with these main refinancing operations, long-term refinancing operations, in short LTROs, structure operations, fine-tuning operations, and at the same time we have these standing facilities. They define the corridor, and then we have these other open market operations to bring the market interest rate, the interbanking market interest rate, as close as possible to the middle of the corridor. And during the crisis, the central bank realized relatively soon that the interbanking market was frozen. So no bank trusted each other. So there was no lending and borrowing as usually across the private banks due to that fact. And then, as you know, one mission of a central bank is, except from macroeconomic stability, financial stability. And here the instrument is lender of last resort. And lender of last resort means providing liquidity to the banking system in case of emergency during a crisis. And that is what the central bank did, in fact. They started to lend more money, more liquidity via these open market operations. But the standard set of open market operations, for instance, for main refinancing operations, liquidity for a week, or for an LTRO for 3 months, was not enough, because there was a lot of demand for longer maturities, a year, 2 years, 3 years, and so on. So the central bank started to extend the current toolbox of open market operations. And here I just list the first extension they did in this field. And these extensions, because they are not standard, that's not what is normally in the rule box, in the toolbox, well, they are called non-standard or unconventional monetary policy measures or instruments. So last time we talked about this allotment procedure, these tender procedures, and then I explained this with an example of a fixed rate tender, and I told you in step 4, this allotment procedure, usually the central bank computes a benchmark allotment, a benchmark supply of liquidity, which is usually below the demand of the financial sector. The supply is mainly just determined by the reserve requirements the private banks have to fulfill. But due to the fact that during the crisis there was a lot of demand and the interbanking market was frozen, the central bank realized we have to provide all the liquidity that is demanded. And therefore they moved from the partial allotment procedure, which is normal, to what we call full allotment. That means if a bank demands 40 million and second bank, let's say 30 million, they will get the full amount, 40 and 30 million or billion euros. So they moved on from allotment to full allotment. That means handing out everything that is demanded. But once again, this money is not for free. It's a reverse transaction, a repo. So you get the liquidity, you give me collaterals, and after the time, you have to pay back the money with an interest rate, and I give you back the collaterals. Another change was, obviously, they realized that what I told you already, that the maturities are too short. So they extended the maturities from an LTRO, which is usually 3 months, first to 6 months. And then they realized even that is too less. They extended it to a year, to 1.5 years, to 2 years. And then the last LTROs, 2 years ago, they were over 3 years. So they provided money, long-term refinancing operations, liquidity over a period of 3 years. Then they continued and said, well, during the financial crisis, all the rating agencies realized, well, the bankruptcy probability increases and so on. So they reduced the ratings of the collaterals of the banks and the assets the banks are holding. And you need the collaterals to participate in these open market operations at the central bank. Reverse transactions. But if the collaterals you are holding is not a AAA, which is usually what you need to participate in these open market operations of the European Central Bank, well, then you have a problem, right? And therefore the central bank realized this due to the financial crisis and the fall in the ratings. They also lowered the eligibility criteria of the collaterals. So now the central bank is accepting also a AA credit or a single A credit or even less of assets. That was in particular problem of Greece, because Greece was downgraded a lot, and then all the banks in Greece were excluded from these operations, and the central bank then implemented special conditions for these countries, not only for Greece, also for the other problem countries like Portugal, that they have still access to the open market operations channel of the European Central Bank. So they helped a lot, these problem countries, by moving on to these non-standard monetary policy measures. This is the second point here. And the third point is the following. Usually, in normal times, so before the financial crisis, that is what I mean normal times, so anything before 2007, or August 2007, if I'm very precise, central banks usually have a certain volume of liquidity that is provided by these main refinancing operations for a week, and by these longer-term refinancing operations, LTROs, for the longer term 3 months. So there's a certain proportion of liquidity in volume. And they realized during the financial crisis, due to the fact that the banking sector or the interbanking market was frozen, there is more liquidity for longer maturities. Therefore, they extended the maturity, and there was more demand in volume for these longer maturities. And so what they did, they changed the proportion, they sized down a little bit the volumes of the main refinancing operations, and they extended the volume of these longer term refinancing operations because there was more demand in this field. And finally, they moved on to the fixed rate tender. That is actually the example we discussed in the previous session. This procedure of providing liquidity. The banks submit the liquidity demands they need, and then the central bank allocates the money. So they allocated the money with the so-called fixed rate tender, and once again full allotment, so there was no allotment procedure, so any demand was fulfilled for 100%. Before the financial crisis, they also used the other procedure which I just mentioned last time, the variable rate tender procedure. So they also moved during the financial crisis and changed this method from the variable rate tender procedure to the fixed rate tender procedure. So you can see that this list gives you an overview of the changes the central bank implemented over time. Not at one time, so they changed it over time by realizing that there's a problem going on in the interbanking market. But then, after a couple of years, they realized even that is not enough. It's not enough to bring the economy back on track. You know, that's the idea of central banking. If the economy is going into recession, the central bank is stimulating the economy as fiscal policy does with a fiscal stimulus package. And they realized this stimulus is not enough. Inflation is still falling close to zero or even slightly below. So they realized we have to even more than just extending the existing toolbox. And so what they did on top, they developed or designed new instruments. And these new instruments were not in place ever before. And that is here. Then on my next slide, here I have the justification, what I told you. So what you can see here is the headline inflation rate from 2008 to 2014. And what you see here, basically, that inflation dropped with the beginning of the financial crisis, subprime crisis, and that was what we call the Great Recession. And during a recession, inflation drops. So that is what we see here. And then, the economy was recovering a little bit. Inflation moved up again. But then, 2010 or so, the European sovereign debt crisis started. And then after this peak here around 2011, you see there's a clear declining trend in headline inflation. And that is dangerous, right? Because the primary objective is price stability, and price stability is not zero, right? According to the definition. Price stability is inflation below but close to 2% over the medium term. And the central bank is arguing, if you take a look to this 2% level, which is somewhere here, now, in the recent years, we are well below this target. So we have to stimulate the economy more. We have to bring back the inflation to our target level, below but close to 2%. And in this time period, so in the last 2.5 years, the ECB implemented new instruments to bring the inflation back up and to stimulate the economy. So what are these new instruments? Here I have a list which is summarizing the key elements. There were even more, but I just concentrate on the key new, non-standard or unconventional monetary policy measures. So one idea was the idea of forward guidance. Forward guidance was first implemented by the US Fed, the Federal Reserve in the US, and then by the Bank of England. And forward guidance means the following. The current interest rate, the main refinancing rate, the key interest rate of the central bank is almost zero. It's 0.05 in Europe. And if it's zero, you cannot stimulate the economy further, and because it's already zero. That's what we call the zero lower bound. And the question is now, how long remains the rate at zero? Because if you know as an investor, the rate is for the next, let's say, months, or for the next year, or for the next 2 years at zero, that gives you confidence to do investment, to plan a new building, and then to finance the building with cheap credit, right? And to strengthen this in confidence, the ECB implemented this idea of forward guidance. And forward guidance means the ECB is telling you, and we will watch a press conference today, and you will hear this. The current interest rate is 0.05, and we hold the interest rate long at this low level as long as the economy is not recovering and inflation is not coming back to or close to our target of close and below 2%. So the central bank is adding a condition to the low interest rate, which tells you, as an investor or a businessman, that you can expect the low interest rates will continue for a prolonged time. And that is what we call forward guidance. In other countries, they even linked this with explicit announcements of conditions. For instance, the Federal Reserve said, as long as the unemployment rate is not falling below a certain threshold, let's say 7%, we keep the interest rate at the zero lower bound. Yeah, so they linked the level of interest rate with the condition so that the market can expect, well, as long as the economy is not doing well, inflation, unemployment is still high, they will keep the interest rate low. So that is forward guidance, to give a guidance to investors, how long will the interest rate be at the low level, at the zero lower bound. Yeah.
You said the Fed used this instrument and also the Bank of England.
Yeah.
How about the ECB?
Yeah, the ECB is now also using this instrument, but they started after the Fed and the Bank of England. So they used the instrument since 2013 or something like that. Yeah. For the first time they announced and said, well, we keep our interest rate at zero lower bound as long as the economy is not recovering and inflation is still falling and so on. Yeah, they have never announced a certain threshold like the Fed did with unemployment or some other conditions, but they are signaling and mentioning this expression of forward guidance as one tool of the policy strategy. Okay, the second point here in this list is a special or two special programs they developed. And one is called the ABS, the Asset-Backed Securities Program, and the other is called the Covered Bond Purchase Program. These programs were developed in the last year, and what they are doing, well, they are buying assets. And why are they doing that? Well, suppose you are a private bank, and what the central bank wants, that you as a bank give credit, loans to businesses. But the central bank realized that the private banks are not really lending money. There are several reasons. One reason, for instance, is that central banks also have to strengthen its own capital stock, the core capital, due to new regulatory requirements, Basel III and so on. And due to that, every money that comes in the past years in private banks is first used to increase core capital to fulfill the new standards of Basel III. So that was one reason why lending was relatively low. But by this instrument, the ABS program, for instance, the central bank buys these assets, and then the bank has liquidity. And so the hope is that if you, as a private bank, have now the liquidity, that you'll lend this liquidity, right? You cannot lend to a business an asset, but if you give the asset, or the central bank is buying the asset, well, then you have the liquidity, and the idea was then you use this liquidity and lend it to the real economy. And the same for the covered bond program. So to help, the idea is to help banks to restructure the balance sheet and to give liquidity to banks to lend to the real economy. But even that was not enough. And then they realized we have to implement and develop a very special new program that provides liquidity, in particular, only to the real sector, to businesses. And that is the so-called TLTRO, the so-called Targeted Long-Term Refinancing Operations. You already know the LTRO, right? That are these long-term refinancing operations, but now there is this T in front, and that means they are special targeted to provide liquidity to businesses. Sometimes they also tell these just TLTROs in short. So this program was started and will continue until 2016. It is operated similarly to an LTRO with this tender procedure, full allotment, and so on. But the financing conditions, so the interest rate you have to pay if you participate in these TLTRO, are very attractive, very low, even lower than for an main refinancing operations or a standard LTRO, which is currently in place. But the condition is you only can get the money if you lend the money to real businesses. So they're linked, the participation and this money out of this instrument, the TLTROs, the TLTORs, with the linkage that the bank has to show, the private bank has to show that they lend the money to businesses. You know, all these open market operations is always an element, you know, to influence the interest rate. So liquidity is always provided to the interbanking sector, and the banks are the participants in this interbanking sector. And then the banks lend money to the real economy. That is the process. So the central bank is never lending directly to real businesses or to any other institution. It's always over the banking sector. Okay, so this instrument sounds very interesting, right? To have a very targeted instrument that gives liquidity only to banks if they give the liquidity in the end to the real businesses. But even that was not enough in the heat of the European sovereign debt crisis. It was around 2012, you know, Greece was in trouble, other countries were in trouble, Portugal, Ireland, Spain, Italy, and so on. And one problem is because the countries usually finance its own spendings by deficits, right? And deficits are financed by handing out treasury bills or treasury bonds. The government prints an asset, and then it sells the asset to a bank. That is usually how it works. But this requires that the government can get the liquidity from the bank and the bank get the asset, means that this asset should be solid, it should be good. And you should trust that the central bank or the government is paying you a certain interest on this asset. But if you believe that the state is bankrupt or almost bankrupt, well, then you only participate in this deal if the interest rate you can get is very high. And that was the case for the troubled countries, in particular in Greece, Italy, Spain, Portugal. So the interest rate really rose, and they were above 20% and more. And at some point, due to the fact that the debt stock in these countries is already very high, and then if they refinance the existing debt with new debt, and they have to pay these high rates, the market realized, well, at some point, this country maybe cannot pay back the debt. And that was the point around 2012 where the ECB realized there is a clear fragmentation in the Eurozone. So we have these problem countries. Here we have a credit squeeze. The businesses get not enough credit. And even the governments have problems to refinance the existing debt because of the high rates they have to pay. And then the central bank thought about what can we do here to guarantee that the euro continues. There is one problem, because the treaty says the central bank cannot finance directly states. That is prohibited in our treaty. So the central bank cannot buy directly bonds from a member state in the euro area. That is prohibited according to the treaty. It's not possible. So they cannot finance Greece directly, or Italy, or Portugal, or other countries. That is prohibited. But due to the fact that they realized at some point, because policy, you know, fiscal policy is also limited, and the central bank was the only European institution that is possible to help at that point. The central bank president announced at a speech in London a program, and that is the so-called OMT program, or outright monetary transactions. And what he said is the following, I quote, the ECB is ready to preserve the euro whatever it takes, and believe me, it will be enough, unquote. That is what Mario Draghi said at a speech in London. The ECB is ready to preserve the euro whatever it takes, and believe me, it will be enough. And by this, the meaning was in the beginning not clear, but obviously what he intended by this phrase was, well, in the worst crisis, the ECB is a lender of last resort for everyone, for every country. So if there's no solution, the ECB, even maybe it's not allowed according to the treaty, the ECB buys government bonds. So that was the intention, and actually, this OMT program was never implemented. Just the announcement by Mario Draghi has led to a decline of the government yields. And after that, the refinancing of the debt by treasury bonds and bills was possible to do for the problem countries because the yields dropped dramatically. Because market expected, well, does not make any sense to speculate on a default because the ECB is ready. They stand behind. You know, this program started a huge debate in Europe because it is until today not clear whether this program is really possible to do because it violates the current treaty. They develop then and they formulate an idea how to implement this, but still there is a current discussion going on, a legal discussion going on in Germany and also at the European level, because some people in Germany and in other countries as well, not just in Germany, but in Germany they moved to the Constitutional Court and said, well, this program is not in line with the European law, and probably that is then also not in line with German constitutional law, because with Germany said, well, when we start the monetary union in the 1990s, we don't want to have risk sharing, we don't want to have a transfer union, we just want to have what we call a rule-based system. And so there was the impression that this OMT program may change the current setup of the monetary union towards risk sharing, towards transfer union. And so some people moved to the Constitutional Court, and then the German Constitutional Court said, well, okay, let's discuss, but this is also touching European law. And the German Constitutional Court obviously cannot judge European law. So then the Constitutional Court in Germany said, we have to ask the European Court. And they did it, and there's no final judgment so far, but the Advocate General of the European Court announced in January 2015, this year, that probably such a program is in line with European law. That does not mean that the European Court will follow this opinion. But the Advocate General, that is the guy who represents the European institution, argues it's possible to do. And now we have to wait for the final judgment of the European Court. And then it goes back to the Constitutional Court in Germany, and the Constitutional Court in Germany has then to judge, given what the European Court will do, whether this is in line with our constitution or not. So there's still some legal uncertainty, but once again, there was, until today, no money has ever been paid by this program. It was just announced. But what they announced in the meantime is this last program on January 22nd, the so-called Extended Asset Purchase Program or Public Sector Purchase Program. This is what the ECB also calls, or the public also calls, the quantitative easing program. now. You know, the Fed, the Bank of England, the Bank of Japan, they used quantitative easing since a couple of years. And now the ECB announced in January this year, we will do something similar. And they started the program in March 2015, and they will buy, that is what they announced, 60 billion euros public and private assets every month until September 2016. And this will increase the balance sheet, the ECB balance sheets, up to, by this program, 1.1 trillion euros. The justification, once again, of this program is inflation is very low, and our goal is to keep inflation below but close to 2% over the medium term, and therefore we have to stimulate, we have to pump in liquidity, increase money supply, and according to the ISLM model, you know what happens? Well, LM curve shifts to the right. But keep in mind, we also discussed, when we talked about the ISLM curve, at the zero lower bound. So if the interest rate is at zero, the LM curve is horizontal. And we have this liquidity trap, right? Can I illustrate this? So let me once again demonstrate the ISLM model at the zero lower bound. You know, we have the output here and the real interest rate here. And then we have this downward sloping IS curve like this. And we have an LM curve at the zero lower bound, which is something like that, horizontal. And we have then our equilibrium point here that defines my output and my interest rate here at the zero lower bound. So the problem here is the following. Let me repeat, we discussed this already. If we increase money supply, you all know that will shift the LM curve to the right. So if I use another color, and if I make this shift of the LM curve to the right, so it shifts the LM curve to the right to LM prime. But you see immediately, this does not affect, in this horizontal segment, our equilibrium point. So it does not stimulate the economy. So monetary policy at the zero lower bound is ineffective. And therefore, the argument is, what can the central bank do instead of that? Instead of just giving liquidity in the market? Well, the idea is the following. If the central bank buys government bonds, OMT or this extended purchase program, if the central bank is buying the bonds of the government, then the central bank gets the bonds and the government gets liquidity. And then the government uses the liquidity to spend. And what happens if the government spends money? Well, the IS curve shifts to the right. Right? And that leads to a new equilibrium. And hopefully it leads to a new equilibrium out of the recession. So they implemented this purchase program, this extended public and private sector purchase program. They buy bonds, then the liquidity is in the public sector. The public sector is stimulating by spending money the economy, that shifts the IS curve, and that has, even in this horizontal segment, right, even if it shifts just to this point, it has an effect on the real economy. And that is the intention why the central banks, the Fed, the Bank of England, the Bank of Japan, use these quantitative easing programs. Because at the zero lower bound, it's probably the only way to have an effect, to design an effect on the real economy, on output. So let me show you a picture that illustrates the quantitative easing in the US, because as you know, they have used the program since a couple of years. And on this graph, you can see two different curves. First of all, you see the liquidity operation, this red curve here. Yeah? The liquidity operations are the liquidity provided by these open market operations, the toolbox in normal times. And you see, usually that's very low. Yeah, they pump in liquidity, and then after 3 months, liquidity comes back, and so on. And therefore, you see, almost nothing has happened in normal times. Then, during the onset and the turmoil of the financial crisis, there was this credit market freeze. The interbanking market were frozen. And at the beginning, what the central bank did, that is the first slide I told you, they extended the liquidity provisions for a longer time and they increased the volumes. And that is what you can see here by this increase in this red curve. And then they realized, as I told you, that is not enough. We are in a very severe crisis and recession. We have to do even more. And they started with quantitative easing. Buying government bonds, or treasury bonds, it's called in the US. And they implemented QE1 and then announced after that a QE2 and then QE3. And what you see here on this axis is the size of the Fed balance sheet in billions US dollar. And you see that they have increased by these instruments the size now up to 3 trillion US dollar. So if the ECB now intends to implement this program, and in the end it leads to an increase by 1.1 trillion, in comparison to what the Fed did, it's even in comparison it's relatively small. But the problem is the exit. The exit from all the programs central banks have implemented in the last years, since the onset of the financial crisis. Because at some point, central banks have to go back to normal. And normal means to the normal implementation of monetary policy measures according to the table I showed you. Main refinancing operations over a week. Long-term refinancing operations over 3 months. And not full allotment, partial allotment. Increase the collateral standards. So they have to go back at some point to these normal measures. That is how it is fixed in the law. These measures I talked about in the past 15 minutes are all measures due to the emergency situation we were in the past years. And that is what we call, so the thinking about how can the central bank go back to normal is the exit of the monetary strategy from these unconventional monetary policy measures. And the first exit, because the US economy is doing a little bit better than Europe, was started in the US by the so-called tapering talks. And tapering talks is a talk about exiting the QE program at the Fed. And what has happened when the chairman of the Federal Reserve, at that point it was Ben Bernanke at the end of his period, he announced that at some point now the Fed will start to reduce the monthly purchase of 85 billion step by step to 80 billion, 75 billion, and so on, and size it down at some point to 0. And after that announcement, without doing it, just announcing at some point the central bank will start to size down the QE, the monthly purchase of government treasuries, the financial market moved into a kind of little crisis. There was a kind of turmoil. Yeah? And that signals to some of the central bankers and to people in the finance community, maybe we have now already created a situation that the financial sector is addicted to liquidity. And if you're addicted, it's quite difficult to exit, to go around, to leave the trucks you are consuming, if you consume anything. Okay, and that's the same here with liquidity. It's the same here with liquidity. And so the Federal Reserve has now continued this announcement, this tapering talks, and since now Janet Yellen, the new Fed chairman, is in office. She has now started to size down the monthly payments of treasuries step by step. So now the Fed, since a couple of months, is really trying to exit the QE. They are not at zero, but they hope that they are going back step by step with the QE program. But this, as you know, is just one program of many other programs they have also to exit, right? This full allotment, similarly in the US, yeah? These increase the collaterals, size down the maturities, and so on and so forth. What is the problem with the quantitative easing program in comparison to what the ECB, the European Central Bank, did so far? These open market operations, LTROs and TLTROs and so on. There is a big difference, and that is important to know. The liquidity provided by open market operations is always based on these repos, reverse transactions. You get the liquidity, I get the collateral, and after a defined period of maturity, 3 months, 1 year, or whatsoever, this is reversed. I give you back the collaterals, you give me back the liquidity plus an interest rate. So what I mean, it's quite easy to absorb liquidity back out of the system because all the liquidity that is provided via open market operations have a certain time frame. If you compare this with quantitative easing, it's different. QE is not based on reverse transactions. Here the central bank is buying government bonds. Then the liquidity is in the system, the bond is at the central bank. There is no termination of this contract. How can the central bank get the liquidity out of the system? Yeah, well, they can only get the liquidity back out of the system if someone in future is buying the bonds they are holding. But suppose the government bonds the central bank is holding are highly risky. You know, the deficit and debt, even in the US, is quite high. And if no investor wants to buy the bonds of the central bank, these treasuries, because they believe at some point maybe even this country will default, the central bank cannot get the liquidity back. There is no reverse transaction. And that means, due to that difficulty, the likelihood that this instrument of QE creates inflation is far higher and far more likely than these reverse transactions. Reverse transactions are terminated. There is a clear time frame, and even the central bank can implement programs to absorb money. With QE, it's different. There is no reverse transaction. It all depends on the assets you are holding. But if there will be no demand in future of the assets you are holding, then all the central banks who implement QE have problems in future, because they will create inflation and they cannot really cool down the economy if no one is buying the assets. That's the only way to get back the liquidity they pumped in with QE. And that's the danger why, in particular, the Europeans said in the treaty, we are against such programs. Yeah, we, as I told you, we have an article in our European treaty that already states it's not allowed to buy government bonds to directly finance states, because that is a high-risk strategy in terms of inflation and in terms of moving on to a risk-sharing European Monetary Union, which was not intended in the beginning in the 1990s with the Maastricht Treaty. Okay, and now what I want to do at the end of this block, I want to show you a press conference, the recent press conference of the European Central Bank by Mario Draghi. And you will see that in this press conference, all the points we talked so far come back. You will hear the definition, you will hear how the central bank president is arguing with the two-pillar strategy, the economic pillar and the monetary pillar. He will tell you about forward guidance. He will tell you something about this extended purchase program we talked about in the recent minutes. So all the elements we have talked about, monetary policy and the European Central Bank, come back in this quick interview or press conference by the central bank president. And online you can see this with a link.